So this is everything you need to know from a tax perspective if you are investing in real estate. My name is Josh Baldovino. I am a real estate investor and one of Derek's clients. And this
Mhm.
is Derek Fujikawa, who's a managing partner of Fujikawa Associates. And Derek, we get these questions all the time, even as I host meetups. And now we've had this podcast for a bit, is all of these
Yep.
tax questions. So let's iron out some of the most common real estate ones really fast. That way you can dive deeper as people want to book a call with you.
Sure.
Derek, real quick, just paint the picture really fast.
Mhm.
What's your CPA background and then your real estate background?
Okay. Yeah, I've been a CPA for since 94. No, 96. I'm sorry. Yeah, almost, oh, wow, 30 years now. I haven't thought about that. I worked for a small firm for a while and then joined my father, and we've had this practice since 97. Yeah, been working in San Jose Bay Area, and I work with all kinds of individuals, small businesses. More recently started focusing more with real estate investors, but have worked with real estate investors throughout that entire time. My wife and I are real estate investors ourselves. We do have one commercial property out of state, three midterm rental, residential rentals here in California in the Central Valley, as well as we invest in a few different syndications.
Sweet. So obviously a good breadth in terms of not only
Mhm.
just a financial background, but also just
Yep.
your own investing. So you're going to talk strategy,
Yep.
multiple takes from there, both from the
Mhm.
investor and CPA standpoint. So again, this is the quick everything you might need to know so that we can dive deeper. But let's dive right into it, Derek. The first question, and most people may actually already know the answer, but why is the tax code positive towards real estate investing?
I think initially it was set up more to stimulate investment into real estate to kind of get more people to invest. So they put some favorable things such as the depreciation, which allows you to deduct the cost of your property over time. But something that can be a kind of a powerful tool. We'll probably talk about that a little bit later. But yeah, that's probably the genesis of many of the tax breaks.
Yeah, there's so many different ones. I think the one that's my favorite is if you live in a primary home and it
Mhm.
appreciates over a certain time and you've lived in it for how many years? Is it
Two out
2
of the
years?
last five.
2 out of 5. And you now can offset a lot of those gains, which as a married couple, you almost offset. What's the limit there?
Yeah, so it's 250,000 for an individual and 200 or 500,000 for a married couple, assuming that you meet the requirements.
So I think that's the best. If you sell your home and you made over
Yes.
500K in profit, I don't think there's any other way that you can make 500K in profit and not.
Yeah, totally tax free.
So that I think is like the best way.
Yeah.
And then the second best way is like a short-term rental loophole, which means
Mhm.
that, oh, actually, Derek, what is that?
The short-term rental loophole is where you can actually so I guess rewind a little bit. Rental properties are generally just by definition passive activities, and passive losses on passive activities are pretty heavily limited, especially if you're making a significant amount of money. However, if you have a short-term rental, you can actually classify it as a business, which then it's no longer passive income or losses, and you can offset that against other active income like your W-2 income or your investment income, any income that you have on your tax return. And the short-term rental loophole allows you to take a short-term rental and actually classify it as a business, where as long as you rent it out for less than 7 days or 7 days or less per stay on average throughout the year, and you materially participate in the property, then it becomes a business, and then you can deduct the losses from that. So you can do, if you have just a regular loss with depreciation, then you can take that against your regular income, or you can accelerate and boost that and do a cost segregation on the property and actually take a very substantial deduction on your tax return.
Yeah, that's the big difference. The case study for
Mhm.
itself, I guess I am Derek's case study there.
Yeah.
And I'll leave that link actually down on the page below. So if you want to
Mhm.
see us breaking down the cost seg and how
Mhm.
much we ended up getting to offset both my wife and my business partner's
Yeah.
income or day job income, that'll be a video that's linked down below. While we're on that same passive versus active income, how about when it comes to like flips or agent commissions? How are those usually taxed as?
The flips it can go one of two ways. If you just do an occasional flip, it would be a capital gain or loss, depending on if you have gain or income. So that has its own separate treatment. It has different tax rates for long-term capital gains, and then you have limitations on losses with capital losses. However, if you're flipping constantly and you're doing it as a business, it'll be ordinary income on your return, or the losses will be deductible against other ordinary income in that respect. So hopefully you're making gains on it, which would then cause you to pay taxes. But if you have any losses, there could be some significant differences if it's capital versus ordinary. Commissions would be something that you're an active ordinary income, self-employment income, or depending on how you're structured, but that's going to be just ordinary income on your tax return.
Are there any favorite ways that either those flippers or agents have been able to either use some of the strategies that you put in place to offset some of those gains that they've had?
So if you're an agent, then you could use that for the real estate professional status. it'll tie into your hours in the real estate business, not necessarily your material participation, but your hours in the real estate business, that 750-hour requirement that they have for real estate professional status, that could help you there. If you have long-term rental properties, those now become businesses under the real estate professional status, and you can deduct any losses from there against your ordinary income.
Okay, so it's all about making sure that everything is classified accordingly. Okay, so we touched a little bit on the long-term versus short-term rental side, and we talked about how they're classified differently. Most people that I meet, all have a
Mhm,
W-2, usually here in the
mhm.
Bay Area. And at
Yeah.
first, they normally start with some long-term rentals. What's the kind of mistake or myth that most people think in terms of using their long-term rentals to offset their tech income?
Yeah, one thing that I see a lot is they just assume that they can take the losses from the long-term rental against their ordinary income, their W-2 income and everything else, which generally, since it's a passive activity, there's some limitations if you make more than $100,000. And if you make more than $150,000, you can't deduct any of your losses from your passive activities against your ordinary income. They're just phased out and then they just get carried forward into future years. You don't lose them completely. They'll get carried forward into future years where you can either take them when your income falls below the threshold or you sell the property. When you sell the property, it'll release all those built up gains. But yeah, so if you're under 100,000, you can actually take up to $25,000 of passive losses against your ordinary income. And then if you're between 100,000 and 150, it phases out over that time. For every $2 you make over $100,000, you lose $1 of that 25,000.
So very specific.
Yes, yeah.
But there still is a way to use it. But yes, if you're thinking about jumping into real estate
Mhm.
investing and you have a W-2, that should obviously be a question that you ask Derek then is maybe what are some of the different ways that we can think about
Yes.
investing that
Yeah.
could be most beneficial?
Yeah, so if you know that you're over 150, you can count
Guaranteed
that you're
return.
not going to be able to take those losses against your W-2 income.
Yeah, yeah, totally. And then in the Bay Area, that's very
Yeah,
common.
yeah, it's
But
not uncommon to have a large W-2 like that. Yeah.
and then I'd say normally too, as you get more active in real estate, the active is like really active for sure.
Yes. Yeah, yeah. It's classified as passive, but you could be putting a lot of time into it, as I know.
Okay, let's talk about maybe those who are a little bit deeper in the funnel, who have, I'm sure if you listen to our podcast, and at some point you probably listen to a handful of other real estate podcasts, but depreciation, cost segregation, what are those? Why are they awesome?
So depreciation is one of those things that make real estate a great investment and a good tool for taxes. Depreciation allows you to write off the cost of anything that has a useful life over a period of time. Let's say we're talking California. So say buy a house for $500,000, you can deduct that over time. So if it's a residential property, you can deduct the value of the building over 27 and a half years if it's a residential rental. And so, that could be a fairly substantial deduction each year that you can take against your rental income. Even if you're positively cash flowing on this, it could create a tax loss. So either if you're over the passive loss limits, it'll just take you down to zero and it won't affect your tax return. Or if you're below that threshold, it'll help create a loss that you can take against your ordinary income.
Okay, so we're just divvying this all up into little chunks that you can use over
Mhm.
time. And cost segregation, why is that powerful?
So cost segregation is powerful if you can classify, well, if your rental properties have a large net income, or if you can be classified as a real estate professional or use that short-term rental loophole, it can create a significant deduction against your rental income. So what a cost segregation does is it'll take the purchase price of your property, and in general, we'll just take a portion of that as the building and cut that into the 27 and a half years and just deduct that over that time period. But if you do a cost segregation in that first year, you can pull out all the little components of the building, the flooring, the cabinets, the appliances, the lighting, all the fixtures, everything, and depreciate those over a shorter period of time, and also use bonus depreciation, which currently isn't that great. It had been a few years ago. If you started this, it was 100% bonus depreciation. So anything with a useful life of 20 years or less, you could write off immediately. Now the bonus depreciation is 40% of the cost for 2025. It'll go down to 20% in 2026 and then go away after that. Unless they change the law, which there has been a lot of talk about that coming back at a full 100%. So if that does happen, then this could be an even more useful tool. Even without all that, you get a 40% deduction on the costs of those items that get separated out. And you can depreciate those over a shorter time period, less than 27 and a half years, a lot of them being 5, 7, or 10 years. So you get a bigger deduction up front and in those early years by doing the cost segregation.
Fair. Okay, this question I'm sure you get all the time. LLCs, trust, how should I structure it? I'm gonna buy a rental. Do I need to make
Mhm.
an LLC? Why would someone consider that?
So an LLC, it doesn't change your taxes necessarily, especially if you're just buying the property by yourself. It becomes a single member LLC, which is a disregarded entity. So the taxes are going to be the same no matter what. Here in California, the state of California assesses an $800 a year franchise fee. So the only thing it really does from your tax perspective is cost you $800 more to pay the state each year for the privilege of having a business entity in California. What it really is for the liability protection. So if you feel like you need that liability protection, then an LLC can be great. The only thing is if you have a mortgage on the property, you have to be careful, because if you move a property into an LLC, title it as the LLC, you could have some issues with the mortgage company with those due on transfer clauses and things like that, where they could call the mortgage if you transfer it to a different entity. But you do just have to be careful with things like that. But if you own the property outright or anything like that, or it's not a problem with the mortgage company, then you can just move it into the LLC.
What about a trust? Why would I want to put a property in a trust?
Trusts, there's two different types of trust. You can use a living trust, which that's more for estate purposes and wealth transfer down the road. It doesn't really help you in terms of taxes or anything like that currently. There's also people who use trusts for privacy purposes. Again, doesn't help you with your taxes. It's for other purposes. And those I would defer to an attorney to set things up and how they're structured. But those would be the reasons to set up a trust to hold your property.
Okay, something good to consider. Last bit is some common write-offs and deductions that as you are starting this real estate business, thinking of, obviously there's travel, there's software, there's your phone costs, there's potentially your cars,
Yep.
there's everything that kind of comes into, hey, I need to pay for this for the business, falls under that.
Yes.
You have a favorite example, maybe how a client has used this in a best case scenario,
In a best case scenario,
or even just like typically?
typically, a lot of times we'll see that clients don't take everything that they should. Yeah, they just take the property taxes, mortgage interest, and maybe the insurance, and we'll throw that in there. But really, everything relating to the property is going to be deductible. So the gardening, the repairs, your travel back and forth, that's a big one that can add up. If it's a long distance away, you can use the mileage rate or your actual costs to travel back and forth to the property if you're doing work on it. If you're using it personally, then that doesn't count. But if you're going there to do work on it and do things with the property for business purposes, then those can all be deductible.
Okay. So there's a lot of things, obviously, this I'm sure will be like in a story time as you get to meet and know Derek, that he'll tell you all the different things and ask you all the questions about how you're actually operating a business. But again, if you are a real estate investor or thinking about buying a rental property, I think it's a pretty good bet that your CPA should also be investing too, because that just gives them a little bit more context to work with. Derek, if people wanted to jump on the intro call, where should they go?
Well, you can always get me on my website. It's at www.fujikawacpa.com, or you can catch me on the socials at DT Fujikawa on Instagram and all the other socials, or just give me a call. I'm happy to talk to clients anytime.
Love it. And I will make that all super easy. So wherever you're watching this on YouTube, if you're on the web page already, we'll leave a link and a button down below so that you can go ahead and schedule and book a call. But again, this is why I like to work with Derek. He also does it too. So if you have rental property questions, you want to make sure that you're doing it right, this is a great place to start. But Derek, thanks so much for all the quick info.
All right. No problem. Thank you.
Guys, and we will see you either down there on the web page or on the next video. Cheers, guys.